Hello and welcome back to another week in the world of Angel Insights, brought to you by Syndicate Room. This is a show that delves inside the world of early stage investing to reveal the tips, tactics and strategies of those making those early stage investments. And I'm delighted to be joined today by Tim Mills. Tim is an investment director at the newly formed British Business Bank and also leads the investment activity and operations of the Angel CoFund, a 100 million investment fund backing promising UK businesses. Prior to the creation of the British Business Bank, Tim spent 5 years with Capital for Enterprise, leading investments into venture capital funds, as well as launching various funds, including the Angel CoFund. And if you're enjoying the show, you can find previous podcast episodes and more information on www.syndicateroom.com in the Investor Academy section. That's definitely worth checking out. But without further ado, I'm delighted to welcome Tim Mills at the British Business Bank. Tim, welcome to Angel Insights. It's an absolute pleasure to have you on the show. Thank you so much for joining me today.
No, thanks, Harry. Thanks for inviting me. A pleasure to be here.
Now, I'd love to start off today by hearing about your background and how you made your way into the world of investing in early stage companies.
Yeah, sure. I guess it's one of those interesting things about venture capital. There seems to be no common route through which people get involved and join the community, as it were. But for me, my early background, my academic background, was studying engineering first, and then information systems. From that, I joined Merrill Lynch as a graduate, trained as an analyst, and then went to work in the capital markets area, essentially in the technology group, but focused a lot on bringing in technology into the bank to help with the trading activities, and did that for a number of years, and then went and did something fairly similar for Barclays Capital, and then ultimately, sort of mid-noughties, decided it was probably time to do something different, take a different direction with my career. Looked for where I might apply my twin interests in technology and my background in financial services and investments, and venture capital was a pretty obvious place to go. I spent a couple of years doing an MBA, focusing on venture, really sort of getting some academic underpinning as far as it goes in the space, and then moved into fund investing in 2008 and spent a few years investing in venture funds. So it was an early investor in Passion Capital and Notion Capital and various others. And then nearly 5 years ago now, we started working on putting together the Angel CoFund. I carried on doing a bit of funding investment for a while, running the two in parallel. I've been doing this pretty much full-time ever since.
And there's so much to unpack there. But I want to start off with the MBA, actually, and discuss it as a kind of beneficial thing to do for angels and for investors. You know, we're seeing a rise, obviously, in operational investors coming from your titans of tech companies. Do you think we're seeing kind of a transition away from the financial investor like everyone says we are, or do you still see the fundamental benefits of taking the more financial MBA route in?
When you look at what the skill set that you need to take an investment from first meeting through to successful exit, it's pretty broad. You do need that financial skill set, you do need that understanding, but you also need a whole lot more than that. So I think an MBA is a useful path for somebody who already has a good grasp of the operational side of things. It's a good way to bolster the skills. But equally, I think if you're somebody who's got a strong foundation in the financial skill set, then maybe the MBA isn't the most obvious reason, and maybe getting more hands-on experience is a good way to go. But I think you're absolutely right. And the trend has been, and when I look at the fund investments that I made, generally looking for people who were not just great stock pickers, but people that could really bring value to the companies they were investing in and really help them grow. And a lot of that is having the operation experience and the network of connections that come with having been an operator.
And I'm really intrigued for you because you said there about being an early investor in Passion and Notion. So how was it sitting for you on the other side of the table and seeing it with the alternate kind of glasses on, so to speak? And how did you take that approach to your learnings investing yourself?
In terms of being an early investor in both of those funds, I think it's fair to say it was it was quite a bold move for us to move away from a more traditional profile of VC fund. Certainly something that we've obviously seen in the US over the years, but not something we've seen so much of in the UK. And one of the real questions for us then was around, do they have the full spectrum of skills? Can they put together a deal as well as support the company and drive things forward? And that was part of the process. In that diligence on them as a team, there were a lot of learnings that came out about the real value that the operators can bring, and that certainly now influences. So our model, of course, is investing alongside angels, and when we're looking for angels to partner with, we're looking for those same kind of skills that we saw in those teams. And a lot of that is having credibility within a sectoral space, having a network of people you can draw on. So whether that's looking for customers or looking for people that you can hire to strengthen the team. And a lot of it is also just simply by being known to be active and successful in a particular vertical adds a lot of strength and credibility to the company you're investing in. And that's a very powerful thing in terms of, say, bringing in employees. Often key is with getting the best hires in is convincing them why they should join this particular business. Often, obviously, they're taking a considerable risk in terms of their own career profile. So giving them the confidence. But also, critically, of course, is bringing in other investors, and particularly later stage VC. Having, as I say, that endorsement of somebody who knows your space, is known to know your space, and recognises is really powerful.
Now, I'm going to be very unfair here, and I'm just intrigued because everyone does have different lendings to which ones they prioritise. Which ones would you prioritise? Would you say it's actually the ability to get the deals through the door, the ability to follow on? What's the one that you focus on?
I guess for us, we tend to be looking for people that are looking at it from the long-term perspective. So we're a generalist fund, so we look at a very broad range of profiles of investments, everything from biotech at one end, where we're looking at very long investment periods or expectation in terms of time to realisation is very long. And we're also looking at small buyouts of trading businesses where you can be looking at realistically a 2 to 3 year turnaround on those kind of investments. So it's a broad church we're looking at, but generally speaking, we're looking for people that are there for the long term, that have the capacity to back through multiple rounds. And when we look at the data for around angel investing, I think, and we're all tempted to put on the rose-tinted view of things, is the sort of 3 to 5 year investment from first investment through to a realization event. But in reality, the data suggests that probably 8 years at the moment is more realistic, and probably 7 rounds of funding is what you should be thinking about.
And I met an investor the other day that said no angel should go into a deal unless they're prepared to do the follow-on funding. Do you agree with that perspective of kind of conforming to having to do an investment in follow-on funds, or do you think it's kind of it should be a one-and-done approach if there's a company that you like?
Yeah, I think it's a very difficult one to give a simple answer to. From an angel group, I think where is the risk? The risk is that as you're coming in as an early investor, that later investors take advantage of that position, particularly if those early investors aren't following, and therefore you suffer from excessive dilution. How does that happen? It's because the group of investors you were aligned with initially aren't able to follow on. If some of that group is able to follow in a meaningful way, then it's likely that they would be able to prevent that dilution happening. But of course, it's also important that the documentation that the legals that are put in place at the time of your investment give you the appropriate protections to ensure that a large investor coming in can't manipulate that position as well. So I think anybody coming in and thinking, I want to invest, but I can only invest once, what are the 2 things you should really look for? One is you need to make sure that those legals that you're going in are robust and you've got the right protection in there. as a minority shareholder. There's only so much you can do. A large investor coming in, putting a lot of money in, is always going to have a lot of sway, and taking a large stake in the company will always have a lot of sway in terms of their proportionate shareholding. But put the best protections you can, or see that the best protections you can get are in there. And the other thing is look around as best you can and see who else is investing at the same time as you. Who are you aligned with? If you're coming in alongside a fund, are they likely to be investing in future rounds? When you look at the angels, the other investors, may also be family offices, institutional investors, corporate investors. Where are they sitting? Are they likely to follow? Do you feel in step with them? And if you can get comfortable that the answer is yes, then it's perfectly reasonable to invest in a single round.
And we mentioned larger shareholders there, so I'm really intrigued here to what extent you focus on building a network around those larger investors to allow that value add of follow-on funding easily to your investments. How much time do you focus on that? And are there any tips you recommend for increasing that network for the follow-on round funding?
Yeah, I think it's something we're quite privileged, and where we sit in the market, that we have a strong network from the angel side through to the institutional side. But it is something we're very conscious of, and do spend time constantly trying to broaden that network and broaden our base of co-investors. But from a company's point of view, it's important. I think a lot of entrepreneurs are quite understandably very focused on doing the day job or getting that next round of funding in. Don't necessarily prioritise getting themselves on the radar of some of those other investors. And I think it's key to really generate awareness that you're out there, that maybe the fund that you're talking to or potentially looking to talk to is not right for this round. You might be looking for too little. Obviously, a lot of later stage funds really won't consider investment proposals unless they're above a minimum threshold, whether that's be 1, 2, 5 million or maybe higher. But it's making as best you can, building connections with those funds early on, telling them the story, introducing them to what you're trying to do, where you're going to get to. Because then when you go back a year later and can give them an update and say, we spoke 12 months ago, we said we were going to do these 3 things. Here we are 12 months on, we've done those 3 things, we've really smashed it out of the park in terms of succeeding against the milestones we set. And now we're looking to raise more funds, and let's have a conversation, because we're now in your sweet spot in terms of the size of investment we're looking for.
And we mentioned the investment size there going up, and obviously that, to a large extent, means, well, hopefully the valuation is going up. So I'm intrigued to hear what role valuation plays in your decision-making process. I spoke to an angel the other day who said it really doesn't matter as long as you get a seat on the rocket ship. So I'm intrigued to hear your thoughts.
Yeah, it's a great phrase. You know, if only we knew which ships were going to be rocket ships.
I'll be there with my bus ticket.
yeah, quite. But valuation matters. It really does in terms of looking at things. But it's not an exact science by any stretch. So the way we tend to look at things is as best we can in a rational, logical way to say, how much are we acquiring as part of the company in a particular funding round? How much roughly do we think the company's going to need in terms of further funding to take it to where it's going to get to, or where it could get to? And then how does that sit against the valuation and the likely exit? And we need to make a return on investment, a reasonable return. And like all venture funds, we're looking at an aggregate return across the fund, and we expect a lot of things are not going to be successful. That tempers our view in terms of the kind of multiple we're looking for on average for our investments. But as I say, we look at across a very broad spectrum of things. So when we're looking at a biotech type investment, you've got to be looking at returns which are 20, 30 times your initial investment, speaking in a very general way. But when you're looking at a trading business with revenues coming in, possibly profits coming as well, then you can take a very different view and you can say maybe a 2 to 3 times return on your investment is reasonable in that case. Understanding the risk in the business is a key part of the valuation, and I think that's often where the disconnect occurs between investor and an entrepreneur is in that assessment of risk. And part of that is for any investor coming in, they obviously don't know the business as well as the entrepreneur. But equally for investors, they tend to come tempered by their own past experiences and where they see the market reference points for those companies.
And on the exit side, again, I seem to speak to many investors. It seems to be a habit of mine. But on the exit theme, I spoke to one the other day who said it's a complete misnomer that all companies need to sell for $1 billion. And actually a £30 million exit is absolutely worth angel and VC time. Did you agree with that? And to kind of what expected IRR do you look for minimum?
Yeah, I couldn't agree. I can agree more with that statement. I think the average exit for a European venture-backed business is probably about 20 million. So that's the average. The median maybe even smaller. So really, when you look at it in those terms, whilst it would be great to have a unicorn in the portfolio, and sure, like everybody else, we hope that we'll get one or maybe even more than one, to go into an investment on the basis that the company you're investing in at a seed stage is going to turn into a unicorn is probably not the best approach. Got to take a more tempered and realistic view and work backwards from that in terms of setting your expectations on valuation.
Mm-hmm, absolutely. And I want to kind of finish then on a reflective stance on the UK environment as a whole now, and hear your thoughts on what you think we're doing well. You've seen the development of the ecosystem. What you think we're doing well now, and then what we're not doing well, and then finish on what Brexit will potentially do. It seems to be the topic of every conversation and every dinner party. So let's start with what we're doing well in the ecosystem.
Yeah, I think what has changed fundamentally in the last 8 years since the bottom of the dip is there is so much support now in the market, both in terms of capital, but perhaps more importantly in terms of understanding and willingness of talented people to get involved in companies. In that sense, we're doing a fantastic job in the UK. On the startup side and on the early side of things, we've got some great businesses emerging, some really, really fantastic people driving those businesses forward and building brilliant teams. And a lot of those businesses are getting funded, and there's a lot more depth of capital available. I think where we still have work to do, and it's early days, is in taking some of those businesses and turning them into really big businesses, and not falling into the trap perhaps where we often do in the UK of selling out early with things. In part, you might say that's to do with institutional investors, but a lot of it is, I think a lot of entrepreneurs maybe are scared of thinking too big in terms of where they might get to. And I think that's the real challenge we need to set ourselves for the next 8 years is how do we make really big businesses? And I'd love to see one of the top 20 global tech businesses in the next 8 to 10 years being a UK-based business.
Do you get slightly concerned by the narrow exit funnel for European businesses with the traditional titans acquiring generally less in Europe than they would in the US?
Yeah, it does absolutely filter down. I think those high multiples aren't available at exit. It tempers the amount of capital that people are prepared to put in early on, and it just reduces our overall risk appetite, and it means that we tend to be less inclined to fund things with substantial amounts of capital in the early stages of development and possibly right through the process. There are those who would always take the view that being lean is not a bad thing, particularly in the modern world where you can do so much more with less in terms of capital requirements. But there's being lean, and sometimes you can be too lean. And where you're faced with a market where you're looking at a land grab type situation where you've got to move fast, it's not just about building the tech, but it's about rolling out the tech, then then capital really does matter, and being able to deploy capital to the company early on really does make a difference.
And then I want to finish today, before the quickfire round, on Brexit. And we won't deliberate long on Brexit, but I just want to hear your thoughts on the effects it might have on the UK startup and investing ecosystem.
Yeah, I guess the most obvious concern is around where it takes risk appetite. In an exit scenario, I think it's inevitable there's going to be a huge amount of uncertainty, and how long that uncertainty is going to last will dictate the impact that it has on the market. But certainly, uncertainty generally isn't good for risk appetite amongst investors, and so a reduction in the availability of capital is obviously our biggest concern in that scenario. I think the other obvious thing that's going to happen is that we'll see a change in the provision of venture capital, European venture capital. The European Investment Fund, alongside the European Investment Bank, have been huge contributors of capital to the UK venture market. And equally, a lot of European-focused venture funds, and even more so with private equity funds, are managed out of the UK. And so we're going to see a shift in that landscape. Of course, it's likely that a lot of that funding will switch from being European funding to UK funding in that scenario. But again, there's going to be a period of uncertainty when that happens. So long term, I'd be pretty confident that we'd have a stable landscape, but a trough of uncertainty in the middle. But I guess the comments I've made focused on thinking through an exit scenario. I mean, the other scenario I think is, and depending which polls you read, the more likely scenario is that we'll end up with a vote to remain. And I think the likely outcome in that situation is going to be quite a positive boost in terms of not for ideological reasons, but simply we'll see a degree of comfort, a degree of security returning to the market, and I think that will have a very positive impact.
And I want to dive into a quick fire round with you now. So I say a short statement and you give me your immediate thoughts.
Sure.
So your favourite investing or tech resource? It could be a blog, it could be a newsletter, a book.
A great question. One of my favourite resources, just because it makes me look really broadly, is just reading the FT and reading the FT tech blog on a daily basis and just skimming through the headlines, because I think it's easy to get a little immersed in the tech press and look a bit too local in some senses in where we are, and it always gives you a more objective perspective on things, which I like.
And then what's the biggest challenge in your role today?
I guess right now the biggest challenge we have is simply we have a big portfolio of companies, and really it is making sure that we're giving people the right support, the right resource when they need it. It's always a stretch in terms of being able to do that, and I think one of the challenges for any investor is always knowing when you're adding value and when you're not, and when you're spending time trying to understand more about the companies you're investing in, more about the issues they've got. You may think you're adding value, but sometimes you're just distracting the guys that you're backing from doing the job. So I think that's the thing that probably concerns me most, is how do we best deploy the resource we've got and use it most in the smartest possible way.
And then which investor do you most respect and admire in the European ecosystem, or in the US actually?
I guess in the European ecosystem, I guess Robin Klein is probably the guy I would most respect. I think there's a certain sort of philosophical kind of connection between us. We run an early stage seed fund, generalist fund, and Robin has been one of the most prolific early stage investors, investing very broadly in the UK, and obviously has backed some fantastic companies. So yeah, I think Robin sort of demonstrates that really doesn't matter how smart you are, it's really hard to pick the winners in any sort of absolute sense. So you've got to have a broad portfolio if you want great successes. But if you do have a broad portfolio, then you can have some great successes.
Mm-hmm. Absolutely. And then I want to finish on the most recent investment of yours and why you said yes, public one that is.
Yeah. So we've got an investment actually which we just closed this morning, which is in a company called 4040 Media, based up in Southport. They develop trainer videos, so animated videos go on websites and are used in corporate trading. So you've probably seen things like RSA Animate, but those kind of elements. A great team. Why did we back them? Fundamentally, the thing we liked about the business most is a really driven entrepreneur, a guy who really, really lives and breathes his business, has taken it from absolutely nothing to the scale it's at today with more than 50 employees, and somebody who's really got incredible ambition for where he can take it. They've got a great product offering, which obviously is essential to get comfortable with it. Though they're based up in Southport, which I've got to be honest, it isn't the most obvious place for a business like that, and did give us some concerns. Can they really scale in that market? Can they really attract the right kind of people in terms of helping them build out? But they have done so far. I think they've got the scope to draw on a wider resource. And if you look at their positioning, most of their business is actually outside of the UK. It's US focused, and I think that the possibilities there are tremendous. So for us, a lot of things to like about it. And ultimately, we're a co-investment fund, so having the right partners to go in with on that was absolutely key. And we're very pleased that the guys that we've got involved with are going to be supporting the company, and they bring an enormous amount of experience in terms of scaling up early stage businesses.
Well, Tim, thank you so much for coming on the show today. It really has been such a pleasure to hear about you and Angel CoFund, and I really appreciate all you've done.
Oh, Harry, absolute pleasure.
And again, I want to give a huge hand to Tim for giving up his time today to appear on the show. So fantastic to hear his views on the current UK ecosystem. And if you can't get enough of Angel Insights, then head over to syndicateroom.com, or you can follow us on @syndicateroom on Twitter, where you can find a whole host of other resources to do with early stage investing and the podcast itself. As always, we're so grateful for all your support and look very forward to bringing you next week's episode.